Something just happened in the gold market that should terrify every banker on Wall Street. And I'm not talking about another record high or some analyst upgrade. What I'm about to show you is far more significant than that. It's a signal, a warning shot fired across the bow of the entire financial system. And the people who understand what this means are already taking action. Let me paint you a picture of what's happening right now. Central banks around the world are buying gold at a pace we haven't seen in modern history. Not just buying it, hoarding it, stockpiling it like their survival depends on it. Because maybe it does. The National Bank of Poland just accelerated their purchases. The People's Bank of China continues adding to reserves quarter after quarter. Turkey, India, Singapore. The list goes on. These aren't small players making emotional decisions. These are the institutions that literally create money, and they're converting that money into physical gold as fast as they can. Now ask yourself this question. Why would the very institutions that print currency be desperate to own the one asset that represents the opposite of paper money? What do they know that they're not telling us? Because here's what makes this absolutely fascinating. They're not buying gold because it's cheap. They're buying it at all-time highs. They're paying premium prices, and they don't care. That tells you everything you need to know about what they think is coming. Let me show you what the data actually reveals. Central bank gold purchases have remained elevated through multiple quarters of record prices. Think about that for a second. Normal investors buy low and sell high, but central banks are doing the exact opposite. They're buying high and buying more. That's not investment behavior. That's panic buying disguised as monetary policy. That's preparation for something they see on the horizon that the rest of us are just starting to understand. And here's where it gets really interesting. The dollar is losing credibility. Those aren't my words. That's what experts are saying as they watch central banks scramble to diversify away from dollar reserves. For decades, the dollar was the undisputed king of global finance, the reserve currency, the safe haven, the asset everyone wanted to hold. But something fundamental has shifted. The trust is eroding, the confidence is cracking, and gold is becoming the insurance policy against a system that's showing serious structural problems. Before we go any further, I want to make sure you have access to the information that could protect your wealth during what's coming. I've put together a free guide in the description below that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, no strings attached. Just click the link in the description and get your copy. Trust me, you'll want this information for what I'm about to reveal next. Now let's talk about what this warning signal actually means for your money. Because this isn't just about central banks playing musical chairs with their reserves. This is about the entire architecture of the global financial system reaching a breaking point. And gold is the canary in the coal mine that's singing louder than ever. Here's what most people don't understand about how the banking system actually works. It's built on confidence, on trust, on the belief that the paper in your wallet and the digits in your bank account represent real value. But what happens when that confidence starts to crack? What happens when the institutions that create money start questioning the value of the very money they create? That's when they turn to gold. Because gold doesn't require trust. It doesn't require belief. It just is. It's been money for 5,000 years, and it'll be money long after every fiat currency in existence today has turned to dust. The technical picture in gold right now is absolutely remarkable. We're seeing consolidation at levels that would have seemed impossible just a few years ago. Support levels that used to be resistance levels that keep getting shattered. And every time gold pulls back, central banks step in and buy. They're providing a floor under this market that's unlike anything we've seen before. It's like watching a poker game where one player has unlimited chips and keeps raising the stakes. Eventually, everyone else either folds or goes all in. But let's dig deeper into what's actually driving this. Because it's not just one thing. It's a perfect storm of factors that are all converging at the same time. You've got inflation that's still running hot, despite what the official numbers say. You've got geopolitical tensions that are escalating instead of resolving. You've got trade wars and tariff uncertainty creating chaos in global markets. You've got the BRICS nations actively working to create alternatives to the dollar-based system. And you've got debt levels in major economies that are so astronomical they can never be paid back through normal means. Let me tell you a story that illustrates exactly what's happening. Back in the early 1970s, the United States faced a similar crisis of confidence. The dollar was under pressure. Foreign governments were demanding gold in exchange for their dollar reserves. And President Nixon made the decision to close the gold window, effectively ending the gold standard. What happened next? Gold went from $35 an ounce to over $800 within a decade. That's not a typo, a 20-fold increase. Because once the link between currency and gold was severed, the printing presses could run without restraint. And they did. Now fast forward to today. We're in a different kind of crisis, but the dynamics are eerily similar. Governments around the world have printed more money in the last few years than in the entire previous decade combined. The money supply has exploded. And just like in the 70s, that money has to go somewhere. It flows into assets, into real things, into stores of value that can't be printed into existence. And the ultimate store of value, the one that survived every currency collapse in human history, is gold. Here's what the smart money is doing right now. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's safe to buy gold. They're looking at the same data I'm showing you, and they're taking action. Because they understand that by the time everyone else figures this out, the opportunity will be gone. The price will have already moved. The insurance will have already gotten expensive. And speaking of insurance, let me share something important with you. If you're sitting on retirement savings of $100,000 or more, you need to understand how a gold IRA works. I'm not talking about buying gold coins and hiding them under your mattress. I'm talking about getting physical gold into your retirement account, completely legally, without tax penalties. I've put together a comprehensive guide that explains exactly how this works. It's in the description below. This isn't about making a quick profit. This is about protecting decades of hard work from the kind of systemic risks we're seeing build up in the financial system right now. Check it out if that's relevant to your situation. Now let's talk about what makes this current situation different from every other gold rally we've seen. Because this isn't being driven by retail investors or gold bugs or conspiracy theorists. This is being driven by the most sophisticated financial institutions on the planet. Central banks don't make emotional decisions. They don't chase trends. They don't buy assets because they're popular. They buy assets because they serve a strategic purpose. And right now, that strategic purpose is clear. They're preparing for a world where the dollar's dominance is no longer guaranteed. Think about what that means. For 70 years, the dollar has been the foundation of global trade. Oil is priced in dollars. International debts are denominated in dollars. Central banks hold dollars as their primary reserve asset. But what happens when that changes? What happens when countries start settling trade in their own currencies? What happens when the petrodollar system breaks down? What happens when central banks decide they'd rather hold gold than dollars? We're not talking about some distant hypothetical future. We're talking about changes that are happening right now, in real time, while most people are completely oblivious. The supply and demand fundamentals in gold are absolutely fascinating right now. On the supply side, mine production has been relatively flat for years. It's getting harder and more expensive to find new deposits. The easy gold has already been mined. What's left requires massive capital investment and years of development. Meanwhile, on the demand side, you've got central banks buying at record levels. You've got Asian consumers who view gold as essential savings. You've got industrial demand from technology and manufacturing. And you've got a growing number of investors who are waking up to the risks in the traditional financial system. Let me give you a specific example of how this plays out. When a central bank decides to buy gold, they're not calling up a coin dealer and ordering a few bars. They're buying tons, literally tons of physical metal that has to be produced, refined, transported, and stored. That metal has to come from somewhere. And when you've got multiple central banks all trying to accumulate at the same time, you create a supply squeeze. The available gold gets absorbed. The price has to rise to bring new supply to market or to convince existing holders to sell. And right now, existing holders aren't selling, they're holding, because they understand what's coming. The COMEX and LBMA markets are where the real action happens in gold. These are the exchanges where futures contracts trade, where banks hedge their positions, where the paper gold market operates. And here's what's fascinating. The ratio of paper gold to physical gold has never been higher. For every ounce of actual metal in the vaults, there are multiple claims on that same ounce. It's like a game of musical chairs where there are 10 people standing, but only one chair. As long as everyone believes they can get their gold when they want it, the system works. But what happens when people start demanding physical delivery? What happens when the music stops? We've seen glimpses of this already. There have been moments when the spread between paper gold and physical gold widened dramatically, when premiums on physical coins and bars spiked, when delivery delays stretched from days to weeks to months. These are warning signs. These are cracks in the facade. And the central banks see these cracks. That's why they're buying physical metal, not paper contracts. That's why they're taking delivery and storing it in their own vaults, because they know the difference between a promise and the real thing. Let's talk about the geopolitical dimension of what's happening, because gold isn't just a financial asset, it's a geopolitical weapon. It's a tool of statecraft. When a country accumulates gold, they're building independence. They're reducing their vulnerability to sanctions. They're creating options for themselves in a world where economic warfare is becoming the norm. Look at what happened when Western nations froze Russian central bank reserves. That sent shockwaves through every finance ministry on the planet. Because if it can happen to Russia, it can happen to anyone, and the response has been predictable. Countries are diversifying away from assets that can be frozen or seized. They're moving into assets that they physically control, assets like gold. The BRICS nations have been particularly aggressive in this regard. Brazil, Russia, India, China, South Africa, and now a growing list of countries that want to join them. They're working on creating alternative payment systems, alternative reserve currencies, alternative structures for global trade. And at the center of many of these discussions is gold, because gold is the one asset that every country recognizes, that every culture values, that can serve as a neutral settlement mechanism when trust between nations has broken down. Here's a question that should keep you up at night. What happens to your savings when the dollar loses its reserve currency status? Because that's not a matter of if anymore. It's a matter of when and how fast. Every empire in history has eventually seen its currency decline. The British pound used to be the world's reserve currency. Before that, it was the Dutch guilder. Before that, the Spanish real. The pattern is always the same: overextension, excessive debt, currency debasement, and eventually collapse. The United States is following the exact same playbook. The only question is timing. And this is where the warning signal from gold becomes so important, because gold is telling us that the timing might be sooner than most people think. When central banks are buying at record prices, when they're accelerating their purchases despite the cost, when they're publicly stating that the dollar is losing credibility, that's not subtle. That's a flashing red alarm. That's the fire alarm going off in a crowded theater. And most people are still sitting in their seats, wondering if it's just a drill. Let me walk you through what a banking system failure actually looks like, because we've seen this movie before. We saw it in 2008 when Lehman Brothers collapsed and the entire financial system nearly went down with it. We saw it in the 1930s during the Great Depression when thousands of banks failed and people lost their life savings. We saw it in Weimar Germany when hyperinflation destroyed the currency and people needed wheelbarrows full of cash to buy bread. The pattern is always the same: excessive leverage, interconnected risks, a trigger event, and then cascading failures that spread through the system faster than anyone can contain. The difference this time is the scale. The global financial system is more interconnected than ever before. The derivatives market alone is measured in the hundreds of trillions of dollars. That's not billions, that's trillions, with a T. And much of that is built on the assumption that the dollar will remain stable, that interest rates will stay within certain ranges, that counterparties will be able to meet their obligations. But what happens when those assumptions break down? What happens when the correlations that are supposed to provide diversification all go to 1 during a crisis? What happens when the hedges that are supposed to protect you turn out to be worthless because the institution on the other side of the trade has failed? This is why gold matters, because gold is the asset that exists outside the banking system. It's not someone else's liability. It's not dependent on a counterparty's ability to pay. It's not a promise or a contract or a derivative. It's a physical asset that you can hold in your hand. And in a world where the banking system is showing serious stress fractures, that matters more than ever. Look at what's happening with bank failures and consolidation. We've seen major banks collapse. We've seen emergency interventions by central banks and governments. We've seen deposit insurance limits tested. And we've seen a quiet exodus of deposits from smaller banks to larger ones, from banks to money market funds, from the traditional system to alternatives. People are nervous. They're not saying it out loud, but their actions speak volumes. They're moving money. They're diversifying. They're looking for safety. And increasingly, they're looking at gold. The technical analysis in gold right now shows something remarkable. We're seeing a pattern that typically precedes major breakouts. Consolidation at high levels, decreasing volatility, building pressure. It's like a coiled spring that's getting tighter and tighter. And when it releases, the move is usually explosive. We've seen this pattern before in gold's history. In the late 70s before the run to $800. In the early 2000s before the run to 1900. And we're seeing it again now. The question isn't if gold is going higher. The question is how much higher and how fast. But here's what most people miss. The real move in gold doesn't happen during the calm times. It happens during the crisis. It happens when fear takes over. When people suddenly realize that the assets they thought were safe aren't safe at all. When the scramble for real money begins. And by that point, it's too late to get in at reasonable prices. The premiums explode. The availability disappears. The opportunity is gone. I want to share something with you that most financial advisors won't tell you. The traditional 60-40 portfolio, 60% stocks and 40% bonds, is built for a world that no longer exists. It's built for a world where bonds provide safety and income, where stocks grow steadily over time, where inflation stays low and stable, where the dollar maintains its value. But we're not in that world anymore. Bonds are getting destroyed by inflation. Stocks are trading at valuations that only make sense if you believe in perpetual growth. And the dollar is losing purchasing power every single day. So what's the alternative? How do you actually protect wealth in this environment? This is where physical gold comes in, not as a speculation, not as a trade, but as a core holding, as the foundation of a portfolio that's built to survive what's coming. Because gold has one job: preserve purchasing power over time. It's done that job for 5,000 years, through wars and depressions and currency collapses and empires rising and falling. Gold has maintained its value, and it's going to maintain its value through whatever comes next. Let me tell you about the difference between paper gold and physical gold, because this is crucial. When you buy a gold ETF or a gold mining stock or a gold futures contract, you're buying exposure to gold's price. But you're not buying gold. You're buying a financial product that's supposed to track gold. And in normal times, that works fine. But in a crisis, the correlation breaks down. The ETF might not be able to get physical metal. The mining stock might get nationalized. The futures contract might settle in cash instead of metal. And you're left holding paper while the people who own physical gold are protected. This is why central banks buy physical. This is why sophisticated investors take delivery. This is why the smart money is moving out of paper promises and into real assets. Because they understand that in a systemic crisis, the only thing that matters is what you actually own, not what you're promised. Now let's talk about the elephant in the room, the national debt. The United States is carrying debt levels that are mathematically impossible to repay through normal economic growth and taxation. The interest payments alone are becoming one of the largest line items in the federal budget. And the only way out is through inflation, through devaluing the currency, through making the debt worth less in real terms by making the money worth less. This isn't conspiracy theory. This is basic math. This is what every heavily indebted nation in history has eventually done. And it's what's happening right now, in slow motion, while most people aren't paying attention. When you devalue a currency, what happens to hard assets? They go up in nominal terms, not because they're worth more, but because the measuring stick, the currency, is worth less. A house doesn't become more valuable because the dollar is worth less. It just takes more dollars to buy it. Same with gold. Same with any real asset. This is why gold rises during periods of currency debasement. It's not that gold is going up. It's that the currency is going down. And gold is simply maintaining its purchasing power while paper money loses its value. Here's a thought experiment for you. Imagine you're a central banker. You can see the debt levels. You can see the unfunded liabilities. You can see the political impossibility of cutting spending or raising taxes enough to matter. You know that the only way out is through inflation, through currency debasement. What do? You buy gold. You accumulate the one asset that benefits from the very policy you're about to implement. And you do it quietly, before everyone else figures it out. This isn't theoretical. This is exactly what's happening right now. The correlation between gold and real interest rates is one of the most reliable relationships in finance. When real interest rates, that's nominal rates minus inflation, are negative, gold thrives. Because negative real rates mean you're losing purchasing power by holding cash or bonds. You're being penalized for saving in traditional assets. So money flows into alternatives, into assets that don't have negative yields, into assets that preserve value. And the ultimate asset for that purpose is gold. Right now, even with interest rates higher than they've been in years, real rates are still barely positive or negative depending on how you measure inflation. The official CPI numbers say one thing, but anyone who buys groceries or pays rent or fills up their gas tank knows the real inflation rate is much higher. And when you factor in the real inflation rate, real interest rates are deeply negative, which means gold should be much higher than it is, which means we're still early in this move. Let me paint you a picture of what the next phase of this looks like, because we're approaching an inflection point, a moment where the slow accumulation by central banks turns into a rush, where the quiet diversification away from dollars becomes a stampede, where the cracks in the banking system become fractures. And when that happens, gold won't move up slowly and steadily. It'll gap higher. It'll have days where it moves more in 24 hours than it used to move in a year. Because that's what happens when fear takes over, when the herd suddenly realizes they're all trying to get through the same narrow exit at the same time. We've seen this before in other markets. We saw it in oil when it spiked. We saw it in certain commodities during supply shocks. We saw it in cryptocurrencies during the mania phase. But gold is different, because gold isn't a speculation. It's not a new technology or a new paradigm. It's the oldest form of money in human civilization. And when it moves because something fundamental has broken in the financial system. Something that can't be fixed with another round of quantitative easing or another emergency rate cut or another government bailout. The banking system is built on fractional reserves, on the idea that not everyone will want their money at the same time. But what happens when they do? What happens when depositors lose confidence and start withdrawing cash? What happens when the velocity of money increases and all that printed currency that's been sitting idle suddenly starts circulating? What happens when the inflation that's been contained in asset prices spills over into consumer prices? These are the questions that keep central bankers up at night, and these are the reasons they're buying gold. I want to be very clear about something. I'm not predicting the end of the world. I'm not saying the financial system is going to collapse tomorrow. What I'm saying is that the risks are higher than they've been in decades, that the warning signs are flashing, that the smart money is taking action, and that gold is sending a signal that anyone who's paying attention should take seriously. For those of you who've made it this far, who've stuck with me through this entire analysis, I want to make sure you have access to the resources that can help you take action. Remember that free guide I mentioned at the beginning. It's in the description below. But here's something extra for people who watch all the way to the end. If you're an American retiree with at least $100,000 in any retirement account, you can get an exclusive one-on-one educational web conference, completely free, no obligation. Just mention that you watched this video. This is only available to qualified individuals, and it's your chance to get personalized guidance on how to protect your wealth from everything we've discussed today. The link is in the description. Don't wait until everyone else figures this out. The bottom line is this. Gold is sending a warning to every bank, to every government, to every investor who's paying attention. The warning is clear. The current system is under stress. The confidence is eroding. The risks are building. And the institutions that understand money better than anyone else are preparing for what comes next. The question is, are you?